Iceland, nowhere was more affected by the global financial crisis, but with a staggering recovery, could the country have found a cure for bad banking? Joining me down the line is Professor Thorolfur Matthiasson from the University of Iceland to find out. Professor Matthiasson, how has Iceland made such a massive recovery since falling apart so dramatically in 2008?
Iceland got rather quickly into a program with the IMF. The agreement was to allow Iceland to run a Keynesian policy. That implied capital controls and gradual balancing of the state budget. It was run by a huge deficit, 10% of GDP in the first year in 2009. This was really a policy opposite of austerity. And we also have to remember that the sector that the collapse was first and firstly the financial sector. Other important sectors like the fishing industry and industries based on harnessing the electricity resources were not affected, so they were mulling on like before.
But in effect, the country experienced mass bankruptcy. How did it even start to deal with this?
At some point of time, we may have had some 80 or 90% of the corporate sector underwater. This is a situation next to heart attack. And you don't cure that with an aspirin. So we had to come up with some methods to sort out what was sustainable of the corporate sector and what was not, and concentrate on not destroying the livable part of the corporate sector. And that is what we managed to do with the debt relief programs. Instead of going through bankruptcy court with all those firms, the banks and the owners of the firm did sit down and negotiate how much each firm were able to pay back all the loans, and then they adjusted the debt to that.
So are you just saying they wiped the debt out, and in that case, where did it go?
This is done mostly by using the impairment accounts of the financial sector wisely. Remember also that 80% of the financial sector itself was in resolution, which was both an advantage and a disadvantage. The new banks that were erected on the ruins of the fallen ones were well capitalized and did not have to raise new equity at the same time as they were solving the debt problems of their customers. So in a way, part of the problem was kind of exported to the creditors, the foreign creditors of the Icelandic banking system.
You wrote that instead of mass foreclosures and bankruptcies, Southern Europe would do well to follow Iceland's example. But with such a small population and so on, isn't it easier for Iceland to take more drastic measures with less risk?
What I advocated is the method of sorting out what is livable and concentrate the effort on keeping those firms alive. Also regarding the household sector, to concentrate on keeping people in their houses if they are not too absurdly big or whatever, and keep the households as customers that are paying back parts of the loans rather than paying nothing, as you have seen in Spain and Italy and other countries that were also hit hard by the crisis. I think that size does not have so much to do with your ability to do this, but you have to think wise and concentrate on, well, take the household sector as an example. If you throw people out of their houses, what are you going to do with the house that you gained if you're a banker? Well, you have to get somebody in that house as a paying customer, and if that person is somebody that another bank has thrown out, well, he's probably not a good paying customer. So you have to concentrate on what you can do with under the circumstances.
So we find Greece in sort of a similar situation, and certainly a tricky situation. So do you think it should pay heed to Iceland?
Greece has a lot of problems that Iceland did not have. Low productivity, corruption, sloppy tax collection, sloppy management of non-performing loans, overmanned state firms, generous pensions. But I think they could learn something from us in terms of debt relief, both for households and for small and medium-sized firms, in terms of less austerity and more Keynesian policy. But we should also keep in mind that Iceland is not out of the woods yet. We are still struggling. Almost 7 years after the crash, we have not gotten rid of the capital controls. We do not have a sustainable solution for our currency problems. New startups emigrate as soon as they get something growing. We have a high GDP per capita, but salaries are low, and we have strikes going on due to that fact now. We don't know how to keep young, well-educated people in the country.